All right, welcome everyone to episode 4 of the Plena Wealth Advisors podcast. Once again, joining us from sunny Kelowna. Craig, how are we doing up there today?
Very well. May the 4th be with you.
That's right. Clark, how's it going? Any protests down in the art gallery this morning?
No, can't see a thing. How are you doing this morning, Jay?
All is well. We've got tax season behind us. I know that's an exciting time and lots to look forward to. So one of the things we're right in the middle of now is first quarter reporting season, which is always a good opportunity to see how companies are doing, hear from CEOs, get a feel for what the market's doing and how things are looking for the rest of the year. So any themes jump out at you for Q1 that maybe we're kind of queuing into at the moment?
Yeah, probably lots to chew on as we record this at the beginning of May. As you said, we're going through first quarter earnings season for a lot of S&P 500 listed companies. A lot of those obviously are held within our clients' portfolios. In addition to that, you've had central banks once again come out with another increase in interest rates yesterday afternoon, with the Federal Reserve south of the border increasing rates by another 25 basis points. I think that's 10 increases now over the last year and a half. More importantly, though, I think what markets have focused on, as you mentioned, is what's happening with earnings. And so far earnings season has been pretty upbeat, all things considered. I think data coming into this morning, you're looking at about a 77% beat rate. So in other words, 3/4 of companies are beating analyst expectations coming into this quarter. And I think a big part of that is expectations coming into the quarter had been ratcheted down, and a lot of the surprises have been coming from technology-based companies, consumer discretionary, and even consumer staples. So not only is seeing earnings come in, better than consensus, revenue is a little bit higher than anticipation as well. So I think that's part and parcel to underlying tones that we've mentioned over the past few podcasts, that the economy is actually doing okay under the surface, and that's being reflected in a number of these companies that we follow closely. And the reason why, outside of the last couple of days, markets have kind of trended 8-10% off of the lows that we saw back in March when we last recorded this podcast. So all in all, I think it's things are operating pretty well within corporate America these days.
I would agree. I'll add a few things. I think, despite earnings coming in better than expected, and I think you mentioned 77% of companies have reported better than expected. I mean, that's close to a historical high. And that's because those expectations were ratcheted down. A lot of that, had to do with a weakening economy, but also the effects of inflation, which we talked about, in previous episodes of this podcast. So what we've seen revenues increasing, fairly strongly. I think part of that is price adjustments due to inflation, but earnings actually declining year over year, despite those earnings beating expectations. And as you mentioned, Craig, where we've seen some of the strongest earnings are with technology companies and other companies that have strong earnings power and the ability to pass, or strong pricing power and the ability to pass those price increases on to consumers. So if you look at a Microsoft, for example, Amazon, Google, et cetera, coming out with quite strong earnings. A couple other things I pick out of that with Amazon, historically for years, a lot of these companies were growing at any expense. And I think, going through a period of inflation like this and an economic slowdown has caused them to rationalize their operations a bit. Amazon, we saw some layoffs over the last 6 months. And we're now starting to see that show up positively in their margins as well. And I think going forward, it won't be the growth at any expense. It'll be focused more on profitability for a lot of these companies. And that's only a positive. The second thing that stands out to me, in our last episode, we spoke about the banking issue south of the border. We continue to see that, particularly over the last few days. But JP Morgan, the largest bank in the United States, what we've seen with their earnings, they came up with blowout earnings. And what we're starting to see is these large banks like a JP Morgan standing out relative to the regional banks. And they will come out of this period stronger. at the expense of some of these, at a handful of regional banks as well.
Yeah, I think that's a good point. I think the focus of our group's kind of portfolio management on the biggest, best companies sometimes can be, seen as a little bit boring and slow, but in tough times, it's always the bigger companies that tend to get stronger, the big fish swallow the little fish sort of thing. So definitely something we're seeing in spades right now as we go through these issues with the regional banks. I think the cost cutting theme is something that has been certainly, strong across the board as companies, right size, and we never want to be, cheering on layoffs, obviously. But as you noted, Clark, it's this kind of maturation of the, big tech companies from growth at all costs to more of an earnings focused type focus. And that's I think really positive for these businesses that can be revalued and begin to look a lot more attractive to investors like ourselves that are really wanting to see strong free cash flows. We want to see things like dividends and dividend increases, and even Google in their quarter announced a $70 billion stock buyback, which was very strong and a signal to the market that management team thinks that the stock is certainly undervalued. So lots of good things to take out of this earnings season for sure.
Well, and I think, Jay, let me just interject there. That's where you're seeing this divergent within broader markets is, after a couple of years coming out of COVID, when you had a massive amount of liquidity, essentially rewarding all asset classes. Now, when that tide comes back in, you're seeing those companies that have managed an environment in a higher interest rate scenario that are now being rewarded, right? And so, you're starting to see, a little bit of margin compression on that, but the efficiency of these businesses that can adapt to a higher interest rate environment, they're showing leadership these days. And I think you mentioned a lot of those names already, and they seem to be technology based.
And we get asked that for a bit by clients, is in an environment like this, and also over the long run, what do you invest in to do well in an environment? And those are the companies that you're starting to see out, and those are high quality, companies that are holding a lot of cash. They have high returns in equity, as Jay mentioned, strong cash flow, strong dividend growth, et cetera. And those are what are standing out in this environment.
And look what's not being rewarded. Those are who have essentially mismanaged their balance sheet and their assets aren't matching their liabilities. And whether if that's commercial real estate, we've mentioned a few times, whether if that's utilities, you're seeing that again, as you mentioned, Clark, with some of the regional banks. So you're really starting to see this dichotomy within markets of what's being rewarded and what's not. And that's generally what you see in what we consider a stock picker's market.
The other interesting thing you pointed out, Craig, a few minutes ago was the narrowness of the market gains this year.
Yeah.
And what's interesting, I think it was Bloomberg a week or two ago, I believe it was Bloomberg, put out a report talking about exactly that, the gains in the narrowness of the market, and attributed 53% of the gains of the S&P 500 this year to the AI theme. So when you look at the Googles of the world, the Amazons, the Microsoft, the NVIDIAs who provide some of the technology behind that, the Salesforces, et cetera, 53% of the gains they attributed to this theme that's emerged strongly over the last few months of AI. That's the other thing I picked out of recent earnings as well.
Yeah, it seems to be coming up on not only technology focused calls, but the industrial companies that are starting to gravitate towards various functions with regards to AI and automation, and certainly something that has been a topic that's been around for quite some time. I mean, at least a decade now, and there's always been this concern about what effect that's going to have on the labor force, and are the robots going to take our jobs? I mean, I think it initially kind of came about when the automatic or the robo taxis came out about 10 years ago, and there was this huge concern about are the taxi drivers all going to be out of a job, and are the truck drivers, which are an incredibly large workforce in the US in particular, are they going to be all out of jobs? And it was at least 10 years ago that this concern started to arise. And I think with ChatGPT and the kind of big step that's made in terms of automation and AI, the concerns have again resurfaced, and now we're starting to see companies, who want to stay relevant and want to stay competitive, really start to talk about how they're going to be using these platforms to, make their businesses more efficient. So certainly a theme that's, going to be, front and center for the foreseeable future. Now, one of the things I picked up out of the earnings calls that we've been kind of paying attention to is IBM had a big headline that suggested 30% of their workforce, their non-customer facing workforce, was going to be laid off or replaced rather in the next 5 years by AI. So a big headline, worrisome number that IBM is actually the 5th largest private employer in the US. They employ almost 300,000 people. Now, if you kind of dive a little bit deeper into that, the non-client facing workforce amounts to a relatively small portion of that. 30% of that amounts to just about 8,000 people. So for a 300,000 person employer to lay off 8,000 people over 5 years is basically a drop in the bucket. And I would suggest that in 5 years, IBM is probably going to employ a lot more people than they do today. So you kind of have to take all of these concerns with a grain of salt, but curious on your thoughts about robots taking over our jobs and kind of what impact that's going to have on the workforce going forward in these years to come.
Maybe I'll tackle that one. It's in conversation with our clients, it's probably more topical now than than probably ever been. And I think it's like you talk about, Jay, it's more kind of this labor market transformation, and you kind of have to look at it from a number of different angles and some of the trends that, we continue to see emerge, whether if that's technologically based trends, geopolitical, macroeconomic, you're starting to see some changes within supply chains. You're seeing this trend towards a cleaner environment push, and you're seeing that amongst governments as well. Consumer preferences. I was thinking about this over the last couple of days, how to relate this to client. I almost look at it as kind of the 4 A's, if I call it that. You already mentioned automation, and I think that's a trend we've seen, over the last couple of decades. And that's a reflection and driven by artificial intelligence, very topical within Microsoft's, the Google's, Amazons of the world. And what that is essentially doing is it's forcing companies to adopt to the changes of automation driven by artificial intelligence. And those companies that continue to adapt to that, I think, are going to continue to be rewarded. And it's all part of this technological advancement. And I know it's scary to a lot of people to hear what's, the progression of AI, which really has emerged within the last 4 or 5 months when ChatGPT came out, as you said. And it's all part of this fourth industrial revolution. And I think you got to look at it from what trends continue to emerge. And you've seen some of the negative trends where jobs that are being taken over by automation, and whether it's going into your local bank or checking in at an airport or checking in at a hotel, you're starting to see those trends of automation take over. So I think a lot of it is technology based, as I mentioned.
I think paradoxically, it's kind of interesting. I mean, the biggest concern currently is that there aren't enough workers available, right? The low skilled job force, whether it's, restaurant workers, you can't find people to work, but that's also, in the skilled workforce, there's just not enough people to work. Yet there's a, longer term concern that there aren't going to be enough jobs for people. So it's an interesting point in time as technology, really ramps up and becomes, more usable. I think, our current iteration of interactions with AI, whether it be Siri on your phone or, the when you get put through a call center and or start talking to a robot, and I mean, everyone's just pounding 0, looking to talk to a real person as quickly as they can. I mean, we seem so far away from having functionality in places, but at the same time, right at the vanguard of when this technology is going to start having an impact on, our everyday lives.
I think you both hit on a few key things. And Jay, the first thing there you mentioned, current, job openings and the, help wanted signs that are out there. I think a lot of that, I could be wrong. We're talking about automation and replacing, people with technology, but I still think a lot of the help wanted is the tail end of COVID. A lot of those jobs are in leisure, hospitality, retail. They're low paying jobs. They don't generally give people the ability to work from home. And those employers are competing for workers, with companies that are willing and able to pay more and give people the flexibility in a job that may be technology related to work from home. And I think that's one of the larger issues. But I think you both touched on, the replacement of jobs with artificial intelligence, automation, technology. And, I think what people tend to forget, we go through this probably once every generation. We went through it with the internet years ago. You think about, back when the automobile with Henry Ford replaced the horse and carriage. And when that happened, Henry Ford started producing automobiles. The people in the horse and carriage industry were all about, well, hey, we're going to lose our jobs. Nobody's going to have a job again. Then there was this production of automobiles. And what ended up happening, just in the early stages of Ford, is Henry Ford was one of the largest pioneers of innovation and automation in his factories. And what that did is it increased the productivity of workers. So I think it was, 5 or 10 years into Ford, each person was producing 400 to 500% more in cars due to the automation that he brought in. That pushed prices down, created more demand for automobiles, which allowed Ford to go out there and hire more people. So you look down the road, and I think you mentioned that, Craig, with these job losses, that yes, there's going to be some job losses, but what replaces those? And what did the automobile industry with that innovation bring on? It brought on the need for the development of highways, gas stations, other technology related to automobiles. And I think that's really the way we need to look at that. I mentioned a minute ago, the internet, when, in the late 90s, early 2000s, when everything started to go online, everybody thought that computers were going to do everything. And I think McKinsey a few years back put out a study that in the United States, they suggested that 19 million jobs since the 90s have been created in personal computing and the internet, and only about 3 million were lost. So a net gain of about 15 to 16 million jobs due to the innovation of the internet and personal computing. That's about 10% of the US workforce. And I think we can probably expect the same with automation as well.
Maybe a good way to summarize it is, certain sectors for sure are going to see job losses, if not permanent job losses, as you talk about, Clark, where you're going to see reemergence of other sectors. So in some ways, it's probably labor market churn might be the best definition of what's going to transpire, in particular based off of automation, as we talked about. And I mentioned McDonald's. I don't know if anybody's seen that McDonald's. I think it's down in Texas. That's one of the first fast food restaurants that is essentially fully automated, that you type in your lunch or dinner order on your mobile app, and then it recognizes your geophysical presence within your app, that links that to that McDonald's, that within a few mile radius of the store, automatically it picks up your location. It produces the order. So when you drive to the drive-through, a machine spits that out through the window. Those are advancements of productivity, as you talked about. Scary, but it's the reality of it.
Yeah, and it's a future. If we look back 20 or 30 years ago with the internet, it was probably scary at the time, or mobile devices, or watches, or whatever it might be. And they're part of the mainstream these days. But I think that it's, there's huge fear of job losses. And I think the way to look at technology and innovation, this goes back 600-700 years ago. You think about 200 years ago, the Industrial Revolution. These are all positives that increased productivity and did not, on a net basis, replace people's jobs. And I think the way to look at this is really these are tools to increase productivity and work side by side with humans as well. So I'd suggest for every job loss, we will at least see a job gain, if not a couple.
Yeah. And I think that's the key point, is like, no matter what industry you're in, whether you're a financial advisor, or you're an artist, or, a teacher, you're going to have to adapt to the new technologies that are available. And it's only going to make you more productive and more efficient. And, looking at our business, we're, using increasing amounts of technology every day. And what we're doing on a daily basis 5 years from now is probably going to look dramatically different than what we do today. And that's going to make us more efficient and, less error prone and all those sorts of good things. So, I would agree. It has to be a net positive, and there's still going to be a reward for critical thinking and being ambitious and being creative and all of the same things that led you into being successful in whatever industry you're in are still going to be rewarded. And it's going to be those people that are, using technology to make themselves more competitive that are really going to, continue to get ahead. And that's going to be the businesses that do the best. So,
well, case in point is this podcast, the ability for us to record this and stream this to our clients and to our listeners. 5-10 years ago, this wasn't even an option within our business model. If it was in the early stages of it. Now this is this is a common theme amongst businesses, is business over internet.
So I think tying that back to kind of markets and the economy, I think the concerns about, this growing, robot army of workers that's going to displace, the economy as we know it is just, I think, overblown for now. Hopefully it's a long ways before, a lot of the traditional, jobs that we know today are going to be taken over. And, from an investing standpoint, the companies that are, taking advantage of these technologies, that are developing these technologies, the biggest, best technology companies that are out there, a lot of which, we spend our time and invest in, are going to be the ways to participate in that. So, there's a lot of good that's going to come out of this. There's a lot of efficiency gains, as we kind of all pointed out, which I think we can embrace and not fear so much as the media likes to do.
Well said. Yeah.
The ongoing circus that is U.S. politics is certainly coming front and center again. We've got a looming debt limit down in the U.S. Along with the presidential candidates throwing their hats in the ring for the 2024 election coming up in about 18 months here. It seems like we just went through this, but what do we have to look forward to on that front as investors? What can we expect over these coming months with U.S. politics and all that brings?
This is not something uncommon for us that have been in the business for a few years now. We kind of go through this cycle every couple, 3, 4, 5 years. I think the most significant one that I recall is back in 2011. That was a big battle between Republicans and Democrats. And, you look back on the desire and the need to continuously raise the debt limit. It becomes a focal talking point amongst political gamesmanship, but every time that debt limit has been raised, I don't think it's any different this time. I think you've seen some progress over the last week or so with Republicans putting something in front of the House, and that looks to be passed. Now it's before the Senate, which likely gets roadblocked because of the demands that the Republicans are putting within their compromises. But at least you're starting to see this rhetoric of Biden coming to the table and wanting to meet with the Republican leadership to expedite the debt limit increase, which I believe now is the early part of June that they need to get something passed. Ultimately, I think it's no different than a lot of other times. It probably leads right up to the 11th hour before getting something passed. But eventually something does, because I think there's too much at risk if nothing does get passed.
I think what people tend to forget, and I get asked this question every time there's a debt ceiling increase, is what's going to happen with the debt ceiling? Is the government going to default in their debt? I think what people tend to forget is the debt ceiling has been increased, 80 times in the last
80 times. Yeah.
50 years.
Yeah.
Exactly. This is a, I say normal thing in the US. Part of that is inflation driven, is that, numbers go up with inflation as far as what the government's needs are and what aggregate debt levels look like. I'd also argue, government spending more and borrowing more as well. That's another issue. But this is not, as you said, Craig, this is not unlike other times. There will be political debate around it. Ultimately, this will get passed and we'll move on and deal with the next issue at hand. Jay, you did mention though, just looking at, the political environment is going to heat up. We've got, Biden threw his, hat back into the ring for re-election. I think, Mr. Trump is he still considered the front runner in the Republican Party? Do we have a repeat of what we saw 4 years ago? And it's, I think, so what we could expect, I think is volatility. You're going to get some headlines, you're going to get some concerns, you're going to get certain parties getting excited. These things create market movements and they create volatility. And I think over the next year and a half, that's probably what we can expect coming out of this as well.
And as an investor, how do you kind of look at that? Are these things to be worried about? I mean, I think we all know the answer, but how do we look at any volatility created by Trump all of a sudden becoming the obvious front runner and the volatility that potentially gets associated with that?
I think you're going to get each side of the aisle with a lot of promises coming into the midterm or coming up into the primaries here. Whether likely as we've seen a lot of those promises fall on deaf ears when it comes time to implementing them, but they're all going to adhere to their base. So yeah, I think for the current administration, there's probably a lot of pressure. If some of the polls that I've read, and this is just from a neutral standpoint, Biden's ratings right now are quite low. In fact, they're the lowest they've been if you go back over the last kind of 8-10 presidents that are in their third term. I think he's only got about a 37% approval rating right now. So I think there's a lot of quote unquote pressure on the current administration to come up with something that again will improve their chances, or at least improve their approval ratings right now.
Yeah, and I think your question, Jay, what do you do or what do you suggest to investors to do through presidential cycle and volatility? What we always do. I mean, volatility, if anything, creates an opportunity over time, and we all know that as we have volatility from whatever source it comes through, the best thing to do is just ride it out. And I mean, we're not going to be able to pick at this point who the candidate will be for the Republicans, nor on election night are we going to be able to predict who is president. So, how can we make, big decisions based on that sort of probability, knowing what the outcome is going to be? I would say, though, that I actually find it quite interesting that, Trump could be the front runner of the Republican Party at this point. And I think, one of the things is that if that starts to become more pronounced, I think we'll see certain market movements related back to some of what his themes and his platform was, when he was president. You think about, some of the issues with China, trade relations, things like that. And I think that's just something to keep on the radar a little bit. If that becomes more of a conversation about him being the candidate, those are the kind of things that we're going to see come front and center again.
I think you really need to look past a lot of that, though. I mean, it's, if we're investing in companies, as we always say, for the real long term, even a presidential cycle is only 4 years. So hopefully businesses are thinking, longer term than that. And as you mentioned, Craig, any promises made on the campaign trail are rarely ever followed through. So it's likely to be a lot of fireworks, but looking past a lot of the noise, as we always say, I think is really the important piece. I think one of the things I saw, Stanley Druckenmiller, who's kind of one of the most reputable investors of our time with a unbelievable track record, came out recently and said that one of his biggest mistakes of his career actually was missing the rally in the US dollar. He's a macro investor that invests in things like currencies, and called it the biggest mistake of his career because he just couldn't get past investing, in Joe Biden and Jay Powell. So, having that political kind of lens cloud his judgment was kind of an interesting recognition. And I think that's something that, certainly I'm a big believer in is, not taking a political promise as something you can, turn around and use as an investment thesis.
I think your points are correct, Jay, and you kind of look beyond a lot of this stuff, and over the long run, companies like a Microsoft that we're talking about, or a Google or a Johnson & Johnson are just going to do completely fine, regardless of what the political situation looks like. I'll open up a can of worms a little bit, and just think that, I think what we tend to do, though, is we think that the long run is going to look the same as what the short run looks like. And I think, what has really stepped up over the last number of years in the United States is this disparity. You've got the right becoming more right or feeling the need to be more right, and the left in a lot of cases feeling the need to be more left. And you've got that polarization. You've got that to some degree from a social perspective as well. And I think those are things that I think, despite things being fine over the long run, I think that's a theme that, needs to be watched over the long run, as there are some issues that have emerged over the last number of years. And Ray Dalio, I'm not sure if you guys have read his book, The Principles of a Changing World Order. I think a lot of that is a little maybe overplayed, to some degree, slightly alarmist in a little bit. But I mean, it talks about that and, looks ahead a number of years and, looks back over the last 500 years of how these superpowers, politically, economically, like the United States is today, how ultimately they do start to see some weakness. And some of these signs that we're seeing are indicative of that. And so I think it's just, have that, I think top of mind, but I think, over the next number of years, we'll continue to see more of the same of what we have seen.
Yeah, and perhaps you even start to hear, this push for someone who leans more independently, that maybe kind of more center left or center right, that emerges. And I think you're starting to see a few names. I'm not going to mention them today, but I would look at that over the next kind of 6 to 12 months. But ultimately, I think you guys, your points are extremely well taken. That, for the here and now, I think markets are overlooking that. I think what we're focusing on and what's driving direction of prices are what's happening with earnings, what's happening with interest rates, what's happening with inflation. And as we noted, earnings are coming in pretty good. I think there's a stat that 95% correlation between the direction of equity markets and the direction of earnings. Well, not surprising, we had an earnings revaluation last year. Equity markets were flat to down for the most part, and since earnings have come out, you're starting to see some positive momentum. Again, a little bit more focused on a handful of names, but earnings will drive direction. I think we can all agree that inflationary trends that we've talked about for the past 4 months in these podcasts are continuing to trend down. Wage pressures continue to trend down. And as we talked about, the Bank of Canada is likely in the final stages of their interest rate tightening cycle. And kind of the rhetoric we get out of the comments yesterday from the Federal Reserve, I'm going to argue that they're probably in their ninth inning as well. So a lot of these there's all these headwinds that we faced for the past year and a half. I think they're behind us now, and on the other side of this, maybe get some tailwinds of not a deep recession, and again, continuing earnings improvement.
I think that's a good summary of where we're at currently, and here we are in May, and hopefully next time we're checking in, we see some more progress on both the inflation front, interest rates, and this kind of economic slowdown that we're currently in, and we can start looking out the other end and getting back to kind of a growing economy. So thanks guys again for the time. Hopefully everyone got a little bit of a window into our conversations today, and as always we appreciate any feedback.